Okay, and welcome back, students who are taking financial accounting. In this series of videos, we are talking about the assigned homework problems, and we're working with the Chapter 1 short exercises. And I apologize for the last video where we were discussing the short exercise S1-2, but I had a little technical glitch where I was about to, I had basically said, oh, it can't be A, it can't be B, it can't be C, so it must be D. But I didn't explain why it would be D, the cost principal. So that's where I'm going to be picking up from here, okay? I gave the reasons why it wasn't, business entity, going concern, or liability. But the reason why the question asks, which accounting concept or principle does Jack violate? And the answer being the cost principle. And the cost principle basically says that when a business acquires an asset, that it should be recorded at its actual cost, right? But so at its actual cost, meaning, let's say I buy, I don't know, let's say I buy a new computer for $500, okay? And that's how much my actual cost is. That's what I'm paying for it, okay? When I go to, I don't know, Best Buy or Staples or something like that. Here he says he proposes to account for the shop's asset at their current market value. Okay. Well, when you purchase an asset, you record it at its actual cost, the $500, not the market value. The market value, I mean, today it might be 500, but let's just say, 6 months from now, it, kind of goes down to say $450. Okay, that's the market value of it. Okay, or let's think about something like an iPad, right? Where or you had the version 6 come out. Well, that immediately decreased the value of the version 5. So if you were buying it in that transition period, your actual cost might have been higher, and then just a few days later, the uh, the 6 comes out, and that lowers the value of the 5. You can't be going and always adjusting the cost of your assets, okay, as the price fluctuates. Whether the value of it goes up or it goes down, is irrelevant. You have to record the value of the asset at its actual cost, what it cost you. And it just came into my mind. Actually, yesterday, this is just as an example, okay? Yesterday, I'm doing some remodeling in a house, and so I'm spending a lot of time at Home Depot. Okay. Now, yesterday, for the first time, I actually went into an Ace hardware store, and I was really surprised that Ace is sort of like a mini Home Depot. Now, I rarely go into Lowe's. Personally, I prefer Home Depot. Okay. Um, as an example, and one of the reasons why I rarely go into Lowe's is because at Home Depot I bought a toilet, right? For it was the price on it was $170. Originally it was $198, and it was on sale for $170. And when I went over to Lowe's, the same price that toilet was $210. Okay, I buy the toilet at $170. Well, I'm recording it at its actual cost, right? If I was buying the toilet if I was buying the toilet as an asset for my business or whatever, okay? If I went to Lowe's and I bought it at 210, that would be my actual cost, and that's what I would record it for. I wouldn't say, okay, I paid 210 for it, but I'm only going to record it at 170 because that's how much it is at Home Depot. And that kind of just came into my mind because when I went to Ace Hardware, I noticed that Ace Hardware is like a mini Home Depot, all right? But I also noticed that the prices were just slightly higher than Home Depot, all right? And so if I buy something at Ace Hardware, even though I'm paying a little bit more for it, that's the price I'm going to pay. And that's what caused me to think about the toilet and giving the example of Lowe's, because I knew the prices there. But generally, I find the Ace Hardware prices to be just slightly higher than Home Depot. Now, whatever you pay for that asset, okay, whatever dollar amount you pay is your actual price. That's the price you record, regardless if, the market value of it is greater somewhere else. Okay. As an example, I was just watching the price of silver, and the price of silver, if you went into the marketplace, the spot price is down to $15. But there's a shortage on it. Okay. And in Chicago, if you wanted to buy a physical piece of silver as a silver bar, it's costing you $30 an ounce. Okay, well, if you buy it at 15, okay, that's your actual cost. Okay, that's what you have to record as an asset, even though the market value in Chicago is 30. Okay, you cannot record it at the 30, so that's why it's violating the cost principle. Okay, right. So the cost principle is you record the asset or service at whatever the actual cost. You don't record it at a market value. Right? Okay, so if you don't understand that, sorry, you have to go back to the other video, the first video, and it'll be labeled S1-2.1, okay, and this one will begin with S1-2.2, only because I made two parts, for this particular problem. And again, I apologize for the technical glitch, but I wasn't going to record a whole 13 minutes over again. Okay, right. So S1-3, accounting terminology. Place the corresponding letter of the definition next to the term. Okay, so number one is liability. Well, a liability is something that we owe to somebody else. So when I look over here, any event, organization form, or no, these are not organization forms. Debt owed to outsiders, E. Right, so this is going to be E. An asset is something we own. Okay. Well, economic resources of the business. Economic resources is something, that we own. So that would be F. A corporation. Okay. A corporation is not a payment of cash, and it's not an event that affects a firm's financial position. A corporation is an organizational form. Okay. In other words, with a single owner is a sole proprietorship. Okay, so B here would be our sole proprietorship because this is an organizational form. An organization form with two or more owners, all right, would be a partnership. Okay, and of course that leaves, just by deduction, an organization form that can have an indefinite life would be D for the corporation. Right? Now, here's the thing about the indefinite life. A corporation could go on forever and ever and ever. Okay, a sole proprietorship is owned by the owner. I mean, I start a business. I started up as a business entity as a sole proprietorship. When I die, that entity dies with me. Okay, so the sole proprietorship dies with me. If I have a partnership, okay, the partnership ceases to exist whenever there's a change in partnership. So if you have a partnership, and like for example, let's say you have a law firm where you have partners. Okay. Um, or even, let's just say, a doctor's office where you start out as a doctor and you might be a sole proprietorship. Okay. And you decide to form a partnership with another doctor. Well, now you have to draw papers for that partnership. So you're changing your business entity from a sole proprietorship, which is what you owned, and you now create the paperwork to create a partnership between you and the other doctor. Right? Now, if your business is growing and you decide to expand and get another partner, right? Well, if you take on another partner, then that old partnership has to be dissolved and a new set of paperwork set up for the new partnership. So the partnership doesn't have an indefinite life. Okay, and obviously you can't have a partnership if it's just you. All right, so when you have a partnership, you have two people. Let's say you only have, every time you add a new partner, the old partnership has to be dissolved. But let's say you have three partners now, and you don't take on any more. Okay, well, the specifications of that particular partnership is such that when one of the other partners dies, that partnership has to be dissolved, and not only, a new set of paperwork and a new partnership has to be created. So if you're sitting here, think of it this way. So if you sit here as a sole proprietorship and you decide to become a partner and so you have two people in the partnership. So the sole proprietorship dies, you create this partnership, between two people. If you decide that you want to take on another partner, so now there's three partners, well, the other partnership has to die because there's three partners. Now, let's say you're going along and one of those partners, wants out or dies or something like that. Okay, well, then a new partnership has to be created, and this other one has to be dissolved, and a new set of paperwork has to be set up. So the partnership doesn't have an indefinite life, whereas with a corporation has an indefinite life. Why? Because there is no owner. Okay, it just, you have stockholders, you have board of directors, you have CEO, but you don't have, even though stockholders are, uh, you know, part owners of the corporation has its own life. You create this new entity. Okay, it's like creating something out of nothing. If you're sitting here as a sole proprietorship and you decide to create a corporation, you are creating another entity, a totally separate entity. And even though you work in the corporation, you are not the corporation. Okay, so the corporation, once it's started, it can go on forever and ever and ever, whether you die or not. Okay, whether you have other people, come in and out or not, the corporation will go on as, forever and ever and has an indefinite life. Okay. All right. So let's see here. Dividends. Okay. So dividends, any event that affects a firm's financial position, no, that would be a transaction. Right. So it's a transaction, and of course then we're left over with dividends being G, a payment of cash to the owners of the corporation, meaning whenever we have, notice it's a corporation here. Okay, you don't get dividends when you're a sole proprietorship or a partnership. Dividends are given when you have stock, and that's all part of being a corporation. So when a corporation has, profit, it can be deemed, but not necessary. The corporation can deem to quote unquote reward the investors by giving them a share of the profit. And that kind of like works as a two-way street in that, nobody puts their money into a business so they don't get a return on investment. Okay, so even though most investors buy stock in the hopes that the price of the stock will go up, if it stays level and it doesn't go up, they're still looking on a return on investment. I mean, why would I invest in something where I'm not getting money back? So one of the ways that they keep investors in the business is by giving them a dividend. So it's a cash payment to the owners of a corporation. Okay? And then, of course, a transaction, any event that affects a firm's financial position, meaning anything that happens in a business, whether it's you buy something, someone buys something off you, um, you create a variety of other things. Those are transactions, and they're just events that happens in a business. Okay. All right, so I'm at 15 minutes, and that's going to be it for these two, and I'll pick up in the next video for short exercise 1-4. And again, if you don't understand something, feel free to pause, rewind, and watch the video again. And if you still have a question, feel free to contact an instructor. Okay.